Trader jumping on here, just entering along in the FAS, which is the three-time bull ETF for financials. Um, Risking that should be 150 on there. So just changing that. Apologies for that. Half size position. Just seeing tech picking up a little bit here. So taking a nibble on something on the long just to see if we get a bounce back. Obviously, financials have been decimated over the last few trading periods. That drop in the 10 years certainly been having an impact. Seeing that bounce from 283 to 287, so about 4 basis points over this recent bounce. Also, that move occurring right after the close of Europe. So, I don't know, just trying to piece things together here, getting a little bit of an extension on some of these indices moving higher. Let's take a quick look at that tick. Definitely a little bit more buying, some meaningful buy programs coming in here over the last 15 minutes or so. Advanced decline line still firmly in bearish territory, down about 2,600, but it has been improving. That put call ratio, as we noted, been pretty steady around that 120 area. Really hasn't been doing too much. VIX has pulled back in a little bit here, dipping below 24 at the moment. So I figure it might be time just to peek my head out. I'm not looking to get into futures and have that much of a extension out there. But certainly a nice move in tech following this breakout. So I want to see if financials could follow a little here.
Hey, Gav.
Yeah, is this
Hey,
Brett?
it's Brett. Yeah, I just wanted to point out there's one other argument that could really help your position here, and I'm going to talk about this with Jim a little bit more, but if we are starting to come to a consensus in the market that the initial reaction to this headline is maybe wrong in that really this news broke a while ago and it has been under the surface in conversations between the U.S. and China probably for the last several days.
Which headline are you referencing?
The big one today, the Huawei Technologies company.
Okay, yeah.
Yeah, that was really, I think that Sunday night in the futures we saw gold and bonds take off on what I would call a war hedge. Basically, as people started to probably were more well-connected and knew about that story developing, because you could also look like the U.S. was taking a political hostage. So I would say that the bond market move that we saw earlier this week may be attributed to that catalyst. And if we start to realize that it's been on the table between Xi and Trump for the last few days, and everybody is acting in a more conciliatory manner around it, then we could see the bond breakout recede along with the gold breakout. And if that happens, it will also make the yield curve inversion scare look like it was maybe headline-driven rather than about closing in on recession. And that has been the primary reason the banks have been so beaten up, I would say. So if we start to get the idea that the yield curve change was actually an overreaction to this story, then we could see a steepener trade come in and your bank trade may really take off.
Well, yeah, I mean, that should be interesting. I mean, the whole thing just struck me, and I don't want to jump too much in on yours and Jim's segment here, but I don't know, the timing of it just struck me as odd. Like, for me, I was of the mindset that they had to have been given some sort of go-ahead to do that. I mean, unless they're just dumb, which I guess is possible. I don't know. It just seems to me like that's a poor negotiating tactic to sit there and arrest a citizen.
Well, unless it's gathering unless it's gathering a piece of leverage that you can then use as a token in the negotiation. But yeah, I get your meaning. It certainly isn't the case. We would have seen military threats on Sunday if they were going to happen. So.
Yeah, it's not like China just found out about that, yesterday. They knew about that. And that's why I said the Commerce Secretary comments right after, which was the first official comments that we got from China outside of news stories about them being irate on everything, was that they were moving ahead. There wasn't any concern about it. There wasn't any pullback from it at all. And I found that to be very odd. Like, I would have thought that the Chinese Commerce Secretary would have had more threats of, we're not buying anything. But it was not that at all, which just kind of led me to believe that maybe that was a little bit of a sacrifice there. Tomorrow is her bail hearing. I wouldn't be surprised to see that go favorably for Ms. Meng. and her being released, and this just kind of, I don't know, it just seemed like a really odd incident to have going on while so many people are at the table trying to negotiate
Yeah,
a trade
no, I
talk.
completely agree. Would she have a travel ban on after bail? Does she live in Canada for a year? They said extradition could take a year.
She was switching planes in Canada.
Yeah.
When they arrested her. So I don't know if she's living in Canada. I didn't see anything along those lines.
No, I know, but would they allow
just
her to leave Canada and go back to China if they're pursuing extradition to the U.S.? If it takes a year, then where is she for that year?
Yeah, I mean, you got to. I think that they let her go back to China, which is
Yeah.
as good as letting her go free. Obviously, she's never
Right.
going to step foot in China or in Canada again. But I mean, also the fact that it happened on Canadian soil too, like, just kind of struck me as odd. So I mean, we'll see how this plays out. But obviously, I was starting to see a little bit more real buying going in the markets at the moment here. And I just thought it struck me as odd that it seemed to occur a lot after Europe closed, and makes me wonder how much.
I would just circle back around and point out, if you look at the TLT chart, for everybody listening, just look at the TLT daily chart and see that move happened 2 days ago. And understand that when there's major geopolitical scares, that's what a chart looks like in TLT. So my guess is that there are people who knew about this story on Sunday, even though the rest of us didn't. And you can see that in the bond market chart.
Yeah, no, that'd be a good point.
Which means if Gavin's theory is right and she's back in China tomorrow or whatever without any other problems, that whole move could be reversed completely, which has massive implications for the yield curve, which has massive implications for the banks and the recent scare that we had earlier in the week.
Yeah, and just from the short end of that stick, let's just take a quick look up. Not to interrupt your piece again, Brett, but Bostic's out saying within shouting distance of neutral rates. And remember, this is on top of some pretty dovish comments from Kaplan earlier and ahead of Powell speaking later. It's only an introductory, so I don't know if he'll touch upon any rates at all, but notes that there's a lot to like about the current state of the economy, and does not expect a surge in investment and likely cooling of recent torrid pace of consumer spending. So overall, decent comments. I think that shouting distance of the neutral rate basically strikes a little bit more dovish tone, at least for 2019. Yep. And then there's no comments on the yield curve if anybody's wondering that. So again, these Fed members seem to be getting a little bit more dovish at the moment.
Yep.
So, all right, well, I apologize. I was trying to give out my FAS trade before you and Jim jumped on, so I'll jump off and I'll let you guys get to it. I'll listen in too, and I got any questions for you, I'll jump in. I'll be curious to hear what you got to say.
All right, and with that, I'd like to welcome Jim into the conversation.
Yeah, hey, I was just going to let you guys run with it,
Yeah, sorry about that, Jim.
Hey, no problem. Thanks, no, you saved me the introduction. I guess you really don't need an introduction, do you, Chart Trader?
I think I do. Go ahead.
Well, we're going to welcome in Chart Trader, who just chimed in with his with his own introduction of me. Well, you know what? I don't get my name out there very much.
I'm taking your job.
Hey, them fighting words. It's a good thing you're far away from me. I don't go down without a fight. Anyway, so I guess the market's not going down without a fight here. We hit those lows right as Europe closed, and we got quite a little bid going on. We were back into the opening range. We're smack dab right in the middle of it. NASDAQ trading at its session highs. You got short a little earlier a couple times. Really nice one in the Dow. Took some profit in the NASDAQ as well, and then took a loss on the next one. But net, it's got to be a positive day to start with. So
absolutely. Could have been really positive if I had let the Dow trade run. I got about 1/5 of what was on the table there. But it was a strange follow-through move, I think, as we're seeing now. I noted earlier this really weird correlation. Usually when you get in an intense kind of sell-off, you've got the VIX ripping higher, you've got put-call up at 140. Normally you get really high correlation across the market, and that's because people stop moving in and out of individual stocks, and they start moving just in and out of index instruments, and it kind of takes the correlation right up through the roof, and everything moves together. And today we just didn't see that. It was just strange, kind of a slow crawling decline, even though it went a ways. but you had a number of different stocks just rebelling against it. And I point out the FANG stocks a couple times as being the obvious there. We've got Netflix, Google, and Amazon all in the green now. And, it just kind of, it was just a weird feeling decline on that last leg lower.
Well, I'll talk about a weird feeling. So you just for full disclosure, ChartTrader isn't in the office looking over my shoulder. I had a question written down about gold and about the other day when you had highlighted that you weren't sure what was going on with gold, and my question was going to be, do you think that, because you know I love conspiracy theories, do you think
I'm with you on this one.
Do you think that gold move might have had something to do with what was going on? You already answered the question, so you can elaborate if you'd like to. Sure.
It comes down to this. In Canada, as this is happening, there's too many people that know about it. It can't be contained. It's amazing it's as well contained as it was. I think simply because many of the people around the situation perhaps didn't understand the global geopolitical implications of what was happening, or else it would have been, we would have seen it on TMZ. You would have seen this everywhere if people had really understood, because there's too many people that would have known what was happening, seen what was happening. There's no way it was perfectly contained, which means, of course, anybody who does understand the implications, the word's going to get to some people who are a little more connected and maybe in charge of a tremendous amount of capital. So I think that there's no real conspiracy theory to the idea that the move in gold and bonds on Sunday night and Monday morning was probably directly as a consequence of this. And, it's really interesting that it didn't leak out any further than that, and that we didn't read about it in the Wall Street Journal on Monday. I think it's remarkable.
Yeah, well, I had two notions. If this didn't get out, then those Huawei phones or whatever don't work very well because they didn't send the signal out, or Jack Bauer was the one who arrested her to keep it that quiet. And that's the only way.
It was well done at keeping a lid on this for as long as they could.
Yeah, I agree. So well, I don't know. Maybe the reporters were snoozing. Didn't think it was a big deal.
Yeah, I think something must be that, or just, people didn't connect the dots, which is, kind of understandable. If you just see the story as it's breaking just in its words, in its most simplistic portrayal, international crisis doesn't jump to mind. But once you kind of realize, oh, wait a minute, okay, this is a pretty big chess piece in the whole grand scheme here, then, it starts to seem relevant enough to knock the market the way that it has. But if that's all correct, if also it's correct, and I kind of think it is, that you can now, if you think back, if you trace along the experience, this was probably known by Trump and Xi while they were having dinner. I would imagine it's too, maybe even, as Gavin suggests, there was some kind of pre-authorization, which means the idea that this is going to result in, if you imagine the worst version of this, the worst version would be something along the lines of how we would feel if, let's say, China had wanted sanctions against France, and we're like, okay, we'll back China on this, even though we don't really necessarily think there's anything wrong with France, but China wants that. And then the CFO of JP Morgan is doing a bond deal with France, and he's on vacation in Singapore, and he gets detained and then put on a plane to China and put in prison. You can imagine the United States government would be pretty upset about that. And with this administration, it might not take too long before there's at least the intimation of a military reprisal unless he's released. So I think that that's probably why one might have seen the possibility that if you're carrying a lot of exposure to this market, you'd need a hedge just for the outside shot, that this turned into actually an escalation into a more direct confrontation between the United States and China, as like a political hostage scenario. But it turns out now, in retrospect, that's not happening. There's no way that that's what's happening. That's not in China's nature, it would appear. And also, they've gone through 3 or 4 days where we've heard statements out of China that depended upon full knowledge that this situation was the case. Those statements still apply. So they've taken this in stride to some extent. And I think then if you look at that kind of worst-case scenario, those hedges in gold and bonds maybe start to come back out. And if that happens, as I was suggesting with Gavin, then suddenly you've got probably the yield curve inversion goes away, especially if at the same time you see a little bit of a dovish lean to the Fed, because, if we're seeing more Fed talk about, hey, we're close to neutral rates, the Fed controls the short end of the curve, the market controls the long end of the curve. So if the short end of the curve starts to recede in yields, right, if it's not pricing in as many hikes coming up, and the long end of the curve starts to move higher in rates because the price of bonds starts to go down because this big hedge starts to come out of them, then you've got a steepener trade. You get a steepener trade when everybody's really concerned about, waking up next week to a 2 to 10 inversion, which is the big recession predictor, when the 10s and 2s reverse. If that whole thing starts to reverse course, we've got the makings here for possibly an aggressive snapback rally if these sort of dominoes start to fall in sequence. One, we get the sense that, this has been in there, everybody's known about this, it's not going to turn into a big deal, especially if, she is back in China next week. And two, that forces the hedge to come out of gold and bonds, which would mean possibly gold is a short here, which is an interesting possibility. And then three, the steepener trade in the yield curve suddenly has the banks storming back higher, along with the NASDAQ, which is not too far from turning green on the day here. It could all lead to a really whipsaw-y kind of thing, and suddenly we're back positive on the year in the S&P to add the final domino, which is, I believe, one of the things that we saw in something that seemed a little bit flash crashy last night if you were watching the futures. As soon as the futures opened, there was kind of a flash crashing move, obviously related to this story, but also I think related to the fact that the benchmark for a lot of money managers went from positive in 2018 to negative in 2018 in a 10-second period. And I have a feeling there may be some quant strategies in there where basically, anybody who's sitting up for the year wants to be hedged out of exposure anytime the market is negative on the year at this point because we're so late in the year. Just the idea that, you score that career ability to say, I was up on the year when the market was down. There's no reason to keep the risk on. Who knows how much down it will be in a couple of weeks. But the fact that we're so close to the year end, so close to bonus counting time, so close to track record logging, it seems unlikely that people who are up a small amount on the year would want to have risk on the table if it looks like the market is turning negative. So there may have been some market mechanics involved in steepness of the initial decline. Now, if we then go back above that threshold, as the banks start to come back, as the bond market starts to slide, then we maybe get the reverse of those orders, so we get like a turbo booster as we head above 2,700. So it's going to be a pretty interesting period here, I think. And really, I'm just trying to kind of confirm some of my biases. I've got some interesting ideas, but I wouldn't call them high conviction at this point.
All right, well, why don't we break those down in just a moment. I really wanted to get your take as to how much the market is baking in what's going on in Europe, in particular France, with the riots and everything.
I'm not really sure how much that is dictating trading at this point. So I wouldn't really...
Okay.
I wouldn't really want to venture to guess at that.
Okay, mostly I was just curious because of the way the market reacted once Europe closed. We saw selling into that, and really the next print, as soon as Europe closed a little more than an hour ago, is when it almost looked like a buying program kicked in, and that marked the low of the day, and here we are, well off the lows here in the S&P futures. Let's see, we're putting a low at 21 and a quarter, and we're trading 40 points off that. So
yeah,
nice,
but it's right. I'm just not sure that it's something that thematically plays into. It's obviously volatility in the politics of France, but I can't see a lot of dominoes off of that, really. So, there's eruptions of all sorts of things, around the world at all times, but usually it's got to tie into something, that really is going to dictate how something else is going to play out, which then dictates how a larger theme is handled, and then it affects a great deal of things. And I'm not sure that I see kind of the eruption of tension in France, really what looks to be kind of against the government, is necessarily something that I see a lot of easy domino connections. So, but yeah, I mean, the timing of, the market turn, a lot of times the market just turns. Then if it's going to turn, it tends to time itself out pretty well, probably because you've got end-of-day positions and end-of-day squaring up going on in European markets, which may be kind of, it's tough for the market to turn. If you've got a turn coming, let's say some kind of major inflection, in this case, from down to up, within 45 minutes of the close in Europe, it may be tough to do it until you get past that close, simply because you've got a lot of institutional order flow that may make it difficult to see the market respond. So when you get past that, there's a lot of stuff that happens at the end of the day as people square up. That doesn't necessarily have to do with the markets pricing in what's going on that day. So maybe it's kind of a magnet situation, I would imagine, not necessarily causal in terms of the narrative.
Sure, and just think about what does the market like to do? It likes to get people offside. So if they're selling all day and they're selling, basically closing at the lows in Europe, what better way than to take advantage of any late sellers or late shorts than to put in the low right at the close, boom, next day Europe opens, we open overnight, things move higher, and like, oh, they didn't participate in the U.S. comeback, and they've got to jump in.
Offsides, yeah, right.
So everyone's offsides again. So, yeah, always keep that in mind when trading. That's a very valuable, just in terms of timing, knowing when these things close, when they open, just to get a sense of how the positioning might be and how you might want to be positioned accordingly. Gavin, did you have a question?
I was just going to put forward, Brett, with the France thing. We've seen Macron obviously having a rash of issues here, just trying to raise taxes, any type of moves off of the lows that we're seeing in monetary policy or any sort of easing or restriction of easing is just being met with a lot of resistance, starting with Italy. So I guess the question would be, do you not see a knock-on effect from, number one, we got the CDU vote on Saturday to see who will take over. Macron seeing the issues at home with the violent protests. All this is coming while they're trying to negotiate with Italy. Do you not see, and while the ECB is also set to end their bond purchasing program this week, do you see any knock-on effects from that?
So you're basically suggesting that there is the question is there any chance that it changes the elephant in the room through all of this is whether or not the rules for EU members can be changed to take away the concept of the budget limitations and the concept of what's really pro-cyclicality in terms of austerity, right? And so do you see any way that this can actually create a critical mass that's great enough to cause a rule change in the EU?
I do, just because, if we see Macron continue to lose power, if we get somebody who's maybe less Eurocentric take over the CDU, then that certainly starts a lot of questions about the current makeup of the EU. It just seems to me like a lot of the weakness might be emanating from there, because we're seeing the banks weaker in the U.S., certainly the yield curve playing a part in that, but the European banks have slipped to two-year lows now. Deutsche Bank looks like it's in real trouble here at the moment as it slips below that 9 level, and I'm just trying to figure out if not so much of this is a concern about a slowdown in the U.S. as much as just some contagion and counterparty risk in the financial sector around Europe in particular.
I mean, you make a pretty good case. And it's tough sometimes for me because, as I think I've said before, my belief deep down inside is that, let's say by the year 2025, there won't be a euro. That's just kind of where I'm at. It's where I've been at for a few years. I think that or either that, or we will refer to the United States of Europe. It's what they're getting closer and closer to having to decide, having to realize that they can't actually create a reality that is this so on the fence. And just one problem after another pops up, and it is all because they're attempting to have a monetary union without a fiscal union. And either they're going to have a monetary and fiscal union, or they're not going to have either a monetary or a fiscal union at some point. So sometimes it's tough for me, I think, to spot the moments of potential greater risk. I mean, are we seeing more spreads blowing out today in Europe than we have been? I haven't even looked.
No, actually, well, that was one of the funny things with the sell-off here today in particular was Italy was one of the better performers there, and there was some comments from one of the Italian members. I don't have which one, but it's one of the more hawkish members who had said that they would go back with some revisions to the EU government. It was De Maio, the Deputy Prime Minister.
Yeah, right. But I mean, what about, like, in general, normally if you're talking about contagion in the financial sector based on kind of headline events, you know, there's not really an issue of contagion unless you're starting to see, I mean, in my experience, the most important thing is to see those kind of basic garden variety bets that we know these banks are all in, which is essentially.
Are you talking about just like in the credit markets, any activity there?
I just mean, you know, Southern European debt to Germany, pretty much. You know, that there's, when those blow apart, that's when you usually see contagion in the banking system related to Europe, and it's tough to see that too much without seeing a big widener in terms of you know, bond spreads.
Yeah, I don't think that there was anything new today on that front per se. I mean, I think that they've been, you know, the spreads have been widening as it is, particularly with Italy and the rest of the group. But overall, just CDS around all these names has been going higher. And I think the primary concern for counterparty risk might be Deutsche Bank, to be honest.
Right. But,
more than anything.
Yeah, okay. Yeah, sure. So, I mean, are they to the point where they've been undermined in terms of capital structure to that extent? And the chart looks awful. I agree with you. There's something stinky.
Right. Yeah, no, I mean, I don't think that we've gotten to that realm in the credit markets at all, but I mean,
right.
I don't know. It was interesting that this bounce started right at the European close, and I'm just wondering if that's really the bigger issue at play here for the markets more so than the trade. The trade's grabbing all the headlines, certainly, but I just wonder how much Europe's weighing in on sentiment here as well.
Maybe. I guess I'm coming from the point of view where I've been watching this all day, looking at it as a sense that, you know, there's this potential for a major conflagration. I think that there's more to the U.S.-China relationship than trade. There's underneath the surface of that, there's a much bigger thing that could start to tip in favor of like a Cold War scenario. And whether or not we go that direction, I think is pretty big for the markets. And I think that whether or not we just took a political hostage is a big question in that narrative. So I think it was a big deal to the market. If it was the worst case scenario, you know, it would be a really big problem that would have the possibility of really crashing the stock market. But it looks like that's not the case. And I think as people are gradually starting to warm up to the idea that this has been something that's really been in play and on the negotiating table for days, and the overreaction to the initial headline is now being recouped as kind of cooler heads prevail over that. I kind of feel like that's the narrative today, but I may be off. It may be that there is a bigger drama in terms of, you know, counterparty risk based on what's going on in Europe. I mean, that's probably contributing. It's probably a multiple factors, but the I don't see anything that's improved in Europe. You know, I mean, their market's closed, but, you know, they're going to open tomorrow. Has anything shifted?
Well, I mean, I guess we'll get a look at that. I don't. There's nothing really on the calendar for them. I mean, probably the biggest thing overnight is going to be Jerome Powell speaking, and there's a few industrial production numbers that are likely to come in weak, an Italian retail sales number. So and also their revised GDP figures. But you know, I mean,
well, I'm just saying, as a sense of like a crisis, weren't we down over 3% on the S&P at one point today?
The stocks was down 3.3%, which was the biggest decline since the Brexit vote.
Right, and now we're almost green on the NASDAQ.
Exactly. I mean, that's
so
what I'm saying.
What changed about the Europe narrative?
Nothing really. It's just selling over from European institutions is what I'm thinking. Because as soon as their markets closed, and that's when we got the bounce, and I was pointing that out. And you can see right at 10:25, we got that little tail risk down there, hit that 26.21 in the S&P, and at 10:30 we were trading at 26.24, and we've basically gone straight up 40 points since then. So I'm just wondering if there's a lot of selling going on in Europe just to kind of protect against some downside of U.S. assets to just kind of raise cash around counterparty risk is kind of the thing that I'm looking for. And again, this is just more or less asking you, and that's why I thought that France does potentially pose a risk here if Europe is indeed the weak link that nobody's really been talking about because the trade headlines have been garnering so much interest.
Yeah, no, I mean, and I would imagine we've got kind of just a more complicated scenario than either of those narratives in and of itself.
Right.
Yeah, I'm sure it's contributing.
Okay, so well, I'll let you guys get back to your conversation then, but we'll be interested to see how Europe plays out over the next few days.
Very.
All right, Brett. So before we started talking about Europe, you had mentioned you had some particular ideas that were somewhat low conviction, and I guess which ones were you? Which ones are if you're going to rank them from highest conviction to lowest conviction? If you have, I don't know.
I can't do that. I can promise you that I can't do that. But what I can tell you is, I'm the low conviction, but kind of growing on me idea is adding to my short in the bond market and shorting gold.
Okay. All right.
So I mean, I can see this being, Gavin's making me think less about that now, because if he's right in terms of how much Europe is playing a part in the market's narrative today, then it doesn't make as much sense to me. But certainly, if this is the idea that we had a kind of major hedge come into place Sunday night and Monday and Tuesday in gold and bonds, into the story breaking as people were scared of how China would respond to the story, and now kind of gradually getting more of a sense that China has already responded to it, and it's not in a very bad way, and probably it's just going to kind of fizzle out as a story. Do we see all that money come back out of gold and bonds? And we've got probably then an overreaction, which would suggest taking out last week's lows in both of those markets. So but I don't have a tremendous amount of conviction in that idea. I think it's interesting, and I think it's also interesting because of the implications, as we discussed earlier, for the yield curve, and how much of a story that was on Tuesday in the decline, and how much that was impacting some of the trade in the banks as well. So if that really, that sense of the inverted 2s and 5s and the potential for inversion on the 2s to 10s is something that was really made more of a massive amount of money coming into the bond market, particularly at the longer end of the curve, as a kind of disaster hedge around this story, and that comes back out again, then suddenly you've got the makings of a pretty vicious snapback steepener trade, and that would have implications for equities pretty dramatically.
So would you consider putting on a yield curve trade, like an actual spread then?
I probably wouldn't play it that way simply because it would have such direct implications for something like what the trade that Gavin just put on. I think that would probably be the easier way to play that trade, because it's going to magnify the outcome of the trade in terms of perception, because it was close to a threshold, right? So whenever you've got a threshold phenomenon in correlated markets, you usually have the bigger trade on something that is correlated to the perception of that threshold rather than the markets that are actually making the threshold. So the bond market wouldn't have to steepen very much to start to show that the idea we're just about to see an inversion on the 10-2s is not going to happen. You could see a ton of hedging come out of something like the KBE, which probably would snap back more violently than the bond market would actually move.
All right. Well, but you could carry that trade longer if you thought it was an actual inflection point.
Well, here's the other problem. I don't have a whole lot of conviction in steepener for very much longer anyways, for other reasons and reasons we've discussed. I think that we've hit some key cycle points in terms of how we're going to see the evolution of economic data going forward for the United States. We've talked about this, like the concept of fiscal stimulus and when it came into the picture and how that impacted perception. Another good piece of data somebody threw at me earlier today is, for the first time since 2006, we saw a year-over-year decline in monthly Class 8 orders for truck machineries. So basically, machinery coming from truck machinery companies for the expansion in the number of big, heavy transport trucks has seen a year-over-year decline for the first time in well over a decade. And that decline is not something that I see as, oh, here's a real problem for these companies. It's actually the other side of it. It's because as we started to get fiscal stimulus coming together, there was a massive spike in people expanding transport capacity because they believed that this would really juice the economy up. And now we're seeing a decline because we're suddenly getting the comparison to that period of spiking. But there's lots of things that are going to look like that, and this will be one of the most leading indicators when you talk about expansion of transport capacity. That's going to be way ahead of a lot of other things. So we're going to see a trickle out over the next 6 months, I think, of different facts like that. And as we see that, we're going to see probably weakness in longer end interest rates and probably very unlikely to see much more steepener trade. So I think that will lead to that inversion. We'll see it, and we'll see it because we exaggerated the upside of the economy basically in Q2 and Q3 of this year. It wasn't organically that strong. It's because people believed that things like the tax cuts and the widespread deregulations were going to juice things up more than maybe they actually did. And that's caused that perceptual jump. That was the bigger stimulus than the actual tax cuts. The stimulus was people hiring lots of people, lending to lots of people, buying new stuff, expanding inventories, expanding transport capacity, all sorts of things in preparation for a very strong economy. And now as we're starting to see data trickle out, it's not as strong as people thought, and we're going to see a lot of year-over-year comparisons that are going to be unfavorable. And I think that that's going to have a broad impact on all sorts of things. At the same time, we're going to see just a massive supply of debt hit, and we're going to see companies come out and probably shift some of their funding structures toward equity issuance rather than rolling all of that debt because of where interest rates are. So I think there's a lot of things that are going to be working against the market that are kind of boring cyclical things, but not super scary cyclical things over the next 6 months, and that's also going to reflect in interest rates.
You know, I just thought maybe that's a big reason why President Trump is so keen on keeping rates as low as possible. Because of that, they're going to need to refinance, and knowing that is going to be a potential, I guess you could almost call it a catalyst to the downside in the market should that unravel.
Yeah, well, that's what I've been saying. Yeah, sure.
Okay.
But your logic is like, so if Trump wanted lower interest rates, then don't organize the fiscal side of your government to lead to the biggest budget deficits of all time and the most massive treasury issuance of bond supply that we've ever seen. So, I mean, that's the major impact on interest rates. It's not the Fed. It's the $1.5 trillion of supply coming into the bond market from Treasury and Fed next year in terms of the balance sheet. So interest rate policy is not the main thing that is causing interest rates to go higher when they're going higher. It is supply of bonds coming.
All right. Well, so at this point, we've got the VIX trading around 24. The put-call ratio isn't as high as it was all day, but still an elevated number. What's your take on the trading, what you might have in store for the rest of the week?
So here's what I think. I think it's going to be a fantastic market to trade. I think this morning should have been more fantastic than it was for me. It was a very easy setup that I initially took. I'm a little bit surprised that I didn't also catch that NASDAQ decline. This could have been a huge day for me if a couple things were different. If we just saw not quite as much of a budge toward testing the early poke highs in the NASDAQ and just rolled over a little bit sooner, I would have been in both of those trades big. And it would have been really fantastic. But as I said earlier, to some extent, right now we're walking through a headline minefield because we don't have full clarification on this story or on the way that it's going to evolve, and we're going to get a few more facts leaked. We're going to understand a lot more about the situation with China and with this extradition order, and with the sort of national security argument being made. Because as we know, this is a little bit like arresting Al Capone for tax evasion. Right. The idea here is that I think the United States believes it has intelligence that this company is up to a lot more no good than just selling U.S. stuff to Iran. And, that they want to know more about what this company is really doing and get more concrete proof, and we're also seeing the rest of the world kind of ally with the United States on this, which means maybe there's a security network sharing of facts that haven't been made totally publicly available. We've got Europe on our side, we've got Canada on our side, we've got Australia on our side with this arrest and extradition order. So it's not, I mean, there's a lot more to this than just Iran sanction violation. This company is seen as laying down, I suppose, an infrastructure of spy technology for China. And that's why we've not allowed them to really do any business with any American companies for a long time. You can't get parts from them and use them in America because we believe deep down inside that it's basically carrying hardware that allows China to, conduct what we would consider to be illegal intelligence. So I think that's really what's going on here, and we don't know the full story, and probably there's a headline minefield here ahead as we get more details on how we plan to deal with this situation. So I'm kind of assuming that any trade that I get in could be blown up one way or the other by a new briefing coming out of the White House, because they probably feel a sense of responsibility at this point to clarify the situation in stages over the next few days. So I think that probably we're going to have a number of different headlines hit that probably suddenly really jerk the tape one way and the other as they happen. And it's a little bit tough for me to want to get too aggressive, even though I love seeing the VIX where it is. And it's kind of like, I'm sitting on my hands, but I'm sort of shaking a little bit. And I want to start pressing the buttons. So it's pretty tough. If I see perfect patterns, I'll obviously try to take advantage of them, but I'm probably going to do it with smaller size. And I'm probably going to do it with a mindset that, I know that I could step on a headline grenade or a headline mine at any moment. And I don't want to have that be too painful if it happens.
All right. Well, we almost got the NASDAQ into positive territory. I saw the triple Qs down only like 0.04%, but it's pulled back since then. Just a little bit here.
But we have
0.5% now in the triple Qs. Go ahead.
I saw Facebook poke green there for a bit, which means that at one point we had Netflix, Google, Amazon, and Facebook all green. So that, it's tough to see this as everybody's really panicking out of the market here if you've got, 4 FANG stocks sitting in the green.
Yeah, and Facebook only down 0.1%. They were downgraded today too, so the fact that they're clawing back off of a negative data point too is a big deal too. All right, Brett. So you're contemplating a potential gold short, potential short in bonds, sitting on your hands in equities. Do you want to talk about crude oil at all?
So, I knew it was going there, and
because I always go there.
I wish that I could really offer a hot take on that one, and it's just every time we come into an OPEC meeting, there's just so much back and forth disinformation. It's incredible. And I swear, I'm going to go ahead and put on your conspiracy theorist hat. There's too much of an obvious incentive and too much of an absence of any justified regulatory authority. Nobody can regulate it if OPEC members were trading crude oil futures into OPEC. There's no way to regulate that. There's no way to stop that. And they know that they can just say, so the oil minister of, who knows what little OPEC member can just come out and just say, we're in favor of a big cut right after they buy a ton of oil futures. Like, there's no way to stop that. And it's so much money that you could make from doing that I'm really cynical about that one. So when we get within a few days of an OPEC meeting, I just kind of go, I don't know what's going to happen, because this is going to be beaten back and forth by leaks and headlines and rumors about, what's going to happen at the OPEC meeting. It just gets so terrible in the few days ahead of an OPEC meeting that I just kind of, I believe that probably we're going to see whatever cut has become the consensus expectation. I think that's at 1.3 million, I believe. I don't know if you.
Yeah, it was 1.3.
Yeah, so I mean, if that's what, it's kind of like the Fed funds at this point. I think they're sensitive to that, especially when they've just made Donald Trump de facto president of the OPEC. they're probably not going to be too surprising with this, and probably they've gotten the okay from the White House to do that kind of cut because probably Trump has started to, probably the United States government has started to hear from oil companies about how bad it would be for the economy if oil were to go too much lower. It's not like a tax cut for everybody because there's also an awful lot of jobs lost. It's a huge industry. And, I think that probably means that, there's a sweet spot in there between 55 and 65 that probably everybody would be pretty happy to see oil at. And I think probably that means we're going to get a cut. But, I don't know. I'm not going to trade that thesis at this point, certainly, given that, we've still got a couple days of the rumor mill to work our way through, and there'll probably be some kind of dump of 50 again and then a slingshot back, and somebody will probably make an awful lot of money on it.
So is that OPEC meeting over now?
Is it?
Well, I'm just looking at headlines. It says OPEC meeting. OPEC reportedly ends with a production cut agreement.
I thought that was coming up.
I thought it was into the weekend, but
So did I.
so yeah, we get rumors on the on the time of this OPEC
There you
meeting
go.
now.
Yep.
See, that's how good they are.
See, that's how little I've been watching oil. I just assumed that it was not. All right, well, I'm going to review that and take a look at it because then there may be a trade.
All right. Well, I'll tell you what. Why don't unless you have anything else you want to add, I don't particularly have any more questions. Gavin, do you?
No, I'm good for right now.
All right. Well, then, I think that's a perfect time to let you look at that and see if there are any trades out there.
Yeah, I mean, when we've got a VIX above 24, I tend to focus on equities pretty much completely. So
Yeah, that makes sense.
and this may be more interesting than I thought in oil. So I'll post on it when I get my own clarification and perspective.
All right. Well, I'll let you get to it. And as always, Brett, thank you so much for joining us and giving your perspective.
You got it.
All right.
Thanks, Jim.
Sure thing.